Good morning, everybody, and thank you so much for joining us this morning. As you know, today we want to talk to you about the view for the AREIT market, and particularly given I think recent discussions in the market around valuations and outlook for the sector, and particularly given yesterday we had an interest rate cut and so on. I think it's a very topical asset class to discuss, and it obviously makes up a large part of clients' portfolios. So today we're going to hear from Danny Eakins. Danny is the co-head of Asia Pacific Real Estate Securities at Deutsche Asset and Wealth Management, and also the co-portfolio manager for the fund. And he's going to go through the market, the outlook, and obviously give you some views around their views around the market and the outlook for the sector. We're going to have about half an hour, at which point we'll open up for questions. And if there are any questions along the way, please feel free to ask. We do like an interactive session. But as I said, it's half an hour with questions at the end. So please jump in. And so with that, I'll hand over to Danny.
Thanks a lot, Alex, and thanks again, everyone, for attending the call. I have my colleague Todd McFarlane with me as well, and so he'll be speaking to the middle part of the presentation. We're going to start with a consideration of the macroeconomic backdrop, the implications for growth and interest rates, and what that means for REITs. We're then going to have a look at the composition of the sector, the recent drivers of strong performance, the current relative valuations, and future return prospects. And as I said, then we'll hand over to Todd to go through a bit of a bottom-up build of looking at some of the individual sectors, retail, office, industrial, and then we'd like to finish off by talking briefly about our approach to managing AREITs, and then we'll take questions. Just move forward the slide. So now you should be able to see a slide, AREIT outlook, macro backdrop. See, the global dynamic is that large fiscal deficits, ageing populations, stretched consumer balance sheets, and still subdued corporate capex are capping economic growth globally to around 1.5%. And though Australia is doing better than that with GDP growth of around 2.5%, the roll down in mining capex, diminishing demand for commodities, and our own tightening fiscal situation mean that monetary policy needs to be highly accommodative. And we've seen that obviously recently with the further 25 basis point cut in cap rates. Most of the, cash rates. Most of the rest of the world has their own version of these same problems. And as the chart on the bottom right-hand side of this slide shows, super easy central bank policies have not just delivered low interest rates, but a large portion, an increasingly large portion of sovereign debt is trading at negative nominal yields. And so, to understand this chart, the blue line is the euro issued sovereign debt, and it shows that 30% of that is, trading at negative real interest rates. So this lower for longer rate outlook is very supportive for AREITs. And if we look at this slide here on the right-hand side, it shows the yields that are available on alternative investments, and it shows that the AREIT sector currently delivers a dividend yield of around 5%. That shows a very wide margin to long bond rates, cash rates, term deposit rates, and a similar level of dividend yield to other equity investments. But if we look at the bottom right-hand slide, it makes a point of the difference between what otherwise seems like similar levels of dividend yield. And this chart on the bottom right-hand side just shows the earnings estimates for based on broker consensus for the AREIT sector versus the broader equity market, and it shows a positive earnings revision for the AREIT sector and a negative earnings revision for the broader equity market. So this speaks to the safety, the relative safety of the dividends that are being produced by the AREIT sector due to the fact that they're underwritten by long-term leases. And I think today we've seen an outworking of some of the other challenges that say, the typically high-yielding sector of the banks are facing, with NAB doing a $5 billion capital raising in order to right its balance sheet. It's their response, I guess, to increasing sort of regulatory pressure and so forth. So take the yield on face value and be wary of those the relative certainty of it when comparing it to equities, and appreciate that it definitely has a strong margin to bonds. This slide here, we just want to point out that the AREIT sector remains, or is, a highly diversified sector that gives exposure to thousands of tenants that are paying rent across hundreds of buildings in various real estate types: retail, office, industrial, residential. And since the GFC, with the exception of rightful specialist offshore operators like Westfield and Goodman Group, AREITs have sold down all of their offshore assets and are focused on Australia. At the same time, payout ratios have reduced and leverage is low. And in the last 13 years, AREITs have outperformed equities 6 times. And an important development that sort of, I think, speaks to the maturing of the global REIT sector, and Australia is part of that, is that in a year's time or thereabouts, the AREITs will get their own separate sector within global equity indices. So currently they sit within financials, and they get a residual allocation as a consequence of a broader allocation to financial equities, banks and the like. From mid-2016, they'll be operate as their own sector, and hence be able to attract dedicated capital flows. The next slide here is just sort of trying to cover why AREITs have had such strong performance of recent times, and as well as the drivers of low cash rates, low bond rates, QE, and the positive effects that QE has on rates and the demand for yield assets such as REITs. Other factors have driven the strong performance, and we note here in the top right-hand box that recent and possible future M&A activity drives cost efficiencies in the sector. The weaker Aussie dollar has been very supportive for the offshore earnings of Westfield, and then an item that can't be understated, and Todd will pick up when he goes through, there's very strong demand for direct real estate assets from both local and offshore investors. And the bottom right-hand chart shows cap rates, and cap rates are the yield that investors in direct property accept when they buy an asset. And so when they pay more, these yields go down, and we can see those yields have been going down. They're prepared in this lower for longer environment to pay more to accept lower yields on these real estate assets. That means asset values are going up, which is supportive to the net asset backing of the stocks that we invest in. So where are we now in terms of relative value? The chart on the top left-hand side shows that, yes, the sector in terms of a premium to its book, the book being a lagged expression of valuation, is above the long-term average, but that average includes a steep discount that applied during the GFC. So it's at trading at 30% plus premium to underlying book values, but we believe that there's 10% upside in those book values, and those book values are partly, are missing the value of the business element. It only reflects the bricks and mortar value, so it doesn't have the value of Westfield's retail management platform, of Goodman's industrial or logistics management platform. It doesn't have the full value of Mirvac or Stockland's residential franchise in there. So when those things are taken into account, we see a stable outlook for the sector. And this last slide of this section here just summarises what our return outlook is. So at the moment, the sector is producing, as I said, about a 5% return, because we think that asset values that are owned by the REITs are going to continue to go up, because we think that we are in a lower for longer rate environment, and because we think that M&A activity will continue to drive cost efficiencies in the sector, and because we are seeing a trend of realisation of highest and best use or change of use. So if an office building ceases to be productive as a place to generate rentals from office tenants, it's converted to residential at a higher value. We're seeing lots of examples of that. So across our universe, we're seeing, we're projecting returns, total returns over the year ahead that range between, there are some negative returns there, but we see, returns from sort of -10 up to +25%, with the sector average in the mid sort of single digits, depending on where the market's trading at the moment. At that point, I was going to hand over to Todd McFarlane to walk through the individual subsectors. Todd?
Great. Thanks, Danny. My role for the fund is really as an investment analyst. So I look at a lot of the data and sort of analyse that and sort of try and come up with a pretty good idea of what's going on in the demand and supply dynamics across the major commercial sectors. It gives us a good outlook for rents. Why is that important? It gives us a good view on where dividend growth is going, and particularly valuations for the REITs. Just as a bit of an overview, I guess market rents across the commercial assets have generally gone sideways to down over the past 2 to 3 years. The slower economy has subdued business and consumer confidence and led to pretty weak demand. From here, though, there are some more promising signs, but we do expect new supply may prevent strong rental growth for a little while yet. Despite this, there has been extremely strong demand for the assets. Asset values have grown strongly, and we expect, as Danny said, at least another 10% upside from here. I'll just go into the first subsector being office, and starting with the two left charts, we can see here that office vacancies have really risen quite a bit. Sydney and Melbourne around 10%. The resource capitals of Perth and Brisbane much higher at around 16%. This has seen relatively weak growth, particularly in Perth and Brisbane, and more modest in Sydney and Melbourne. Generally, office landlords can start driving rents a little bit more once vacancies sort of pull back below 8 to 9%. Once we start to look at what's in the supply pipeline and factor that in with a reasonable demand outlook, we don't think they'll get back to that level till about 2018. The bottom right chart shows that office demand, however, has recently been lifting in Sydney and Melbourne, which is a good sign for those markets. And typically, the REIT exposure to those markets of Sydney and Melbourne is about 60 to 75%. Just going to the next slide in retail. The retail asset class has suffered both cyclically and structurally in recent years, and will take a little while to work through yet. Having said that, landlords are actually doing a pretty good job in managing the transition and still having sort of occupancies around 99 to 100%, which is a good result. Cyclical pressure on retail sales has been obviously driven by lower wage growth, uncertainty around employment, and rising utility bills. But as we show in the chart on the top left, the blue line shows that retail sales volumes have been improving. Record low interest rates, lower petrol prices, and improving consumers are improving consumers' willingness to spend again, and clearly buoyed by the wealth effect from stronger house prices. Structural pressures faced in the industry, though, are really with the retailers themselves. As you can imagine, 23, 24 years without a recession, there's a number of retailers out there that are relatively inefficient compared to international retailers now entering the market, and that's putting pressure on their margin outlook. So we expect there'll be a little bit of ongoing pressure on market rents for the next 2 years. Industrial, if I go to the next slide, has seen the highest growth in asset values, largely due to the strong demand for the higher starting yields of around 8%, but being driven more and more, driven lower more and more by the day. Rental growth, as we show on the next chart to the bottom left, has though been subdued across the main markets. If I now go into residential on the next slide, it should be little surprise to hear that there has been strong house price growth across all markets, but as you can see in the top left chart, Sydney and Melbourne have really had their fair share. Prices have been rising quickly due to extremely strong demand from lower interest rates and international buyer interest, and particularly from Asia. We would have all seen the headlines around that. It's been the investor market though, which has been the real driver of demand in this cycle. And the chart on the bottom right shows the strong pickup in investor loan growth, particularly in Sydney. So the residential developers have actually benefited from strong price growth. Their sales volumes are also up around 30%, but they're also experiencing margin improvement, as we can see in the chart on the bottom left. And that's really from the price growth and volume growth, but also as they roll off lower margin and impaired projects. So the outlook for the residential developers, in our view, is still quite bright. I'll just move on to the next section, where we'll, and in this section we highlight some of the key reasons why we still think AREIT exposure is beneficial. To a portfolio strategy. You know, we believe they still have a healthy and safe distribution yield, as Danny has talked to. There's certainly a high degree of certainty around their earnings, which are growing, and largely stable rental income with low downside risk. We also think they're defensively positioned. Their balance sheets are in good shape, diverse debt sources, and armed with the lessons of the GFC. And we expect demographics will play a big part here. With interest rates globally as low as they are, and many yielding instruments struggling to give you a real return, we expect the growing number of retirees globally will see defensive yield stocks outperform in time. Just going to the first point, Danny's already talked to that first chart there. You know, we think it presents as good, if not better, and superior return in terms of dividends to many of the alternatives. We'd also argue, though, that asset value support from yield-hungry investors provides some comfort that we'll likely see less downward volatility in share prices in the medium term. You know, the price reaction of the banks is probably a good case in point in recent weeks, down 6 to 8%. And as Danny pointed to, NAB is raising $5.5 billion today on the market, and that's at an equivalent 15.6% discount to their yesterday's current share price. We'll let you have a look at the bottom two charts, maybe in your own time, but essentially what we're showing here is that if you're concerned that 10-year bonds rise and the spread between dividend yields, you know, we see the spread between dividend yields and the yields on assets as close to cyclical highs, so there's sufficient buffer in there, not, in our view, not to see asset value downside at this point in the cycle. We just go to the next page, looking at the degree of earnings certainty that we have with the REITs. When we were talking about before the pressure on market rents, we're of course talking about the pressure on rents if you sign a new lease today. But nearly every lease in commercial property factors in some kind of contracted annual increase every year if you're subject to an ongoing lease. So the top left chart shows the typical rent increase ranges that we see in lease agreements. And you can see there that they are generally about 2 to 3% at a minimum, growing each year. So it's really only the 10 to 20% of your portfolio that is expiring leases that would be subject to those market rents, which are a little bit lower today. The REITs have also got pretty good long expiries. You can see in the next chart that the minimum is 5 years on a weighted average basis across the portfolios, and then some of the alternative asset classes have very long lease expiries of up to sort of 9 to 11 years. The REIT's earnings growth has also benefited from continued lower interest rates, and there's still a little way to go there. We've seen the most recent lower interest rate cut yesterday. I'd say, on average, the weighted average interest rates for the REITs are probably about 50 to 60 basis points above what they can actually borrow at today. So you'll see continued tailwind there for earnings growth in time. Just going to the next page, we look at the balance sheets of the AREITs, and we think they're in good condition. We see the average gearing level there for this sector now around 31%, in line with the through-cycle average, and we see this improving as asset values rise. The bottom left chart shows that the average gearing of the major REITs is just around 30%, and each of those are well below their balance sheet gearing covenant levels set by lenders, so we have no concerns there. Finally, the AREITs generally pay out about 80% of their earnings, so they're not playing any tricks in terms of paying out too much, and therefore driving their gearing up over the near or medium term. So we think the AREITs have got defensively positioned in terms of gearing, but they're also generally well diversified across a number of assets, asset classes, and also geographies. Just going on to the next page. Here we highlight that demographic changes will likely favour yield investments. As we see in the top left chart, the black line represents the emerging significant bubble of people aged 65 and over around the world. And about this time, they start to seek investment products which are generally more defensive. History suggests that defensive yield stocks outperform and show excess returns as that ageing population starts to seek out those yield products. The next chart is a few days old now, but really generally showing that the market anticipates, on the left, that generally the market anticipates an easing bias on interest rates, making the AREITs defensive 5% yield look even better compared to term deposits. So AREITs have ageing demographics as an attractive tailwind, and generally we expect interest rates will remain lower for longer, making defensive yield plays attractive. The final slide I will talk to is just shows that asset values have been going up, really off the back of very strong demand for those assets. We can see in the top left chart that transaction volumes across the office, retail and industrial assets has picked up in the past 3 to 5 quarters, predominantly in office and retail, and that's more so because just where there has been stock available for sale. The next chart on the bottom left shows that there has been a solid lift in the appetite from domestic buyers, but more interestingly is stronger growth over the past 2 years from international investors. And that's because the yields off the Australian assets are generally far higher, and they recognise that these are quite defensive given the contracted annual increases in rents in lease agreements, as we spoke about earlier. I'll now hand back to Danny, who can take through to the next slide.
Okay, thanks a lot, Todd. Yeah, I just wanted to briefly make a couple of points before handing over to you guys for questions and addressing how we approach the management of the AREIT portfolio. So basically, we're trying to add value across the whole market cap spectrum. We don't have a small cap bias. We're not just focusing on the large cap end. We invest across the spectrum, and if we look in our portfolio, you'll see that we have exposure to stocks that are sub $1 billion, as well as exposure to stocks that are, over $8 or $10 billion. We also have the ability to take tactical international exposure, and these are in rent collectors, not developers. This exposure is limited, it is tactical, and it's been very effective in adding value to the portfolio since we implemented it approximately 18 months to 2 years ago. As Todd said on the way through, we are a bottom-up manager. We do the detailed work, we leverage our real estate knowledge, and we take conviction positions in our portfolio that we think through the long term will generate excess returns. At that point, I thought I might hand it over to the audience for questions, and then we may do a wrap-up after any questions, if that's all right, Alex.
Yep. Thank you, Danny. Thank you, Todd. That's fantastic, and thanks for your insights. Is there any questions from any of the audience? So if you want to ask a question, please just type it into there's a panel on the screen that you have with a sort of text box, and you can type in any questions there.